Good morning, everybody. It is the day after Thanksgiving, and I'm still tired. November 27th, 2020. Yeah, what do they put in those turkeys to make you tired? Tryptophan, is that what it's called? Yeah, between letting the dogs clear the plates and what I eat, we all woke up at about 3 o'clock in the morning and had to have a walk. So today I want to cover just a couple of things. Seeing as there's all sorts of Black Friday giving away into Cyber Monday sales, I want to cover the news by going through some of my favorite sources and show you some things that I think will be helpful. And I will provide links to as much as I can in the YouTube, as well as I will throw out an article with a bunch of discounts as well. And I'll explain to you why I'm really reliant and using some of the things that I'm using. So I get no affiliate membership discounts here, but I can tell you that Bloomberg, which is where I absolutely spend the most time, is doing $199 today for your first year. And if you're going to subscribe to any financial press, this is the one that I recommend. It's the easiest to look at. They have absolutely the most data and information. You have to remember that Bloomberg made his money by selling data and information to the financial industry and to big business. So their network and their artificial intelligence, their network of analysts and writers, nobody's close. Financial Times isn't close, even though they have good coverage globally. New York Times isn't close. Wall Street Journal isn't close. These are the guys that you want if you want information. And there's a ton of it out there. And their opinion pages are geared towards finance and economics versus politics. So I would, if I were you and you wanted one news source that was going to give you the news and all the different things that you're going to use as an investor, I'd say get Bloomberg, pay the $199 a year, and then I will tell you that's for your first year. Sometime in the spring, and this is what they did for me, sometime in the spring, they send you an early renewal offer so that you can continue the discount. And I don't know if mine went lower or higher. I think I'm paying $240 a year, and that's like locked in forever. So you're getting an actual better deal than I would get. Some of the things that I like about this is then you pull down the menu here, which they've made it really easy to use. You can take a look at whatever you want to take a look at. You know, if you want to take a look at the stocks, what the futures are, you know, before you go to bed at night. I look at this almost every night, see what the futures are. You can do that. They can give you currencies, commodities, anything that you want. Sector analysis, right? This is something that we use pretty regularly. Right? I talk about sector investing all the time. So this is something you can take a look at and see what the hot chart is. Notice, and we're going to talk about energy today. The energy is down. It's starting to give back that performance that it had in November, and we'll see what happens there. I think the OPEC meeting is going to be a big deal. They have the new economy stuff, which we talk about all the time. Green economy, which we talk about all the time. Something that's newer is they have City Lab, which really helps you understand what's going in the economy at a grassroots level. And you'll remember that I've talked about the trips that I take around the world, well, the country, the driving trips I take around the country every year. And usually I do 2 or 3. So I'm putting 15, 16, 17, 18, 19,000 miles, maybe 20,000 miles on my car every year, just driving around from Milwaukee through the Rust Belt up into the Northeast, down to Florida, over to Texas, you know, back up through Missouri, Tennessee, Illinois, Iowa, heading out west to the Dakotas. I fly over the Rocky Mountains. I haven't really had a lot of desire to drive over them since I was leaving Yellowstone one year with my kids, and we went over the Sawtooth Mountains. Not a big fan of driving over really big mountains, especially if there's switchbacks. If you haven't subscribed to this, seriously, you need to take a look at it today. You get the podcast, you get the radio. It's just it's the total deal. So if you're a longer term investor and you don't need instant information, this is where you can really get your fill. So again, I would just, I opened with Bloomberg because I think it's that important that you have it. I don't have a discount for you or an affiliate code for you. I'm just telling you that this is the thing that you need to get information. Wall Street Journal is good. Financial Times is good. This is just so easy to use online that it's really unbeatable. And if you want to spend a couple extra dollars, I think it's $10 extra a year, you can get Business Week magazine too. The other thing that I spend a lot of time on, and I'm on Bloomberg every day, is ValueWalk. And I've talked to you about ValueWalk. I don't really highlight their stories, and I should, just so you understand what they're doing. But I use their data and I use the ideas in here all the time because they have the 13F screener in here for finding out what hedge funds are buying and selling. So if you go here, you see that they have all the current hedge fund letters from Q3 as they come out. So if you want to know what somebody's talking about, if you want to know what the best hedge funds are talking about, come in here and say, okay, I want to find, whatever. You pick a hedge fund that you're interested in, and I want to know why they're buying what they're buying. Their letter is here, and you can read, so Pershing Square. You take a look at Pershing Square, you say, okay, what is this guy buying? And this is just a performance update, but you can find what they're doing. So if you want to know what the world of hedge funds is doing, this is by far the best site out there for this. And they do quite a bit more. One of the things I want to talk about today is combining fundamental with technical analysis. This is something else that we talk about. So they recently did a podcast about it, and they specifically talked about the acquirer's multiple. You hear me talk about what the market is missing all the time and what makes a company ripe for a strategic transaction. So a lot of times I'm looking for a good company that you can buy with the idea that somebody else might buy it down the road, that it might get taken over, or that it might merge. So I'm looking for financial characteristics on top of business characteristics that will give you that edge. Now, the acquirer's multiple is actually built on top of Joel Greenblatt's magic formula, which we've talked about before. The difference between the two is that the magic formula takes into account business quality, right? You have to make a qualitative analysis of how good you think that business is. The acquirer's multiple basically strips that part out and it's just more quantitative. So between the acquirer's multiple and the magic formula by Greenblatt, you can really, I think, find a great universe of stocks. I lean towards the magic formula part where you analyze the business on top of what the formula is talking about. But there's a book on both, and I will provide links to both of these. I will make about 40 cents on that if you buy it through my link. The acquirer's multiple really describes some things that I think would help you as an investor. I will say it's not entirely practical because they're talking about buying entire companies. But when it comes down to buying the stock, you can apply the ideas to buying the stock. Greenblatt's book obviously has been a bestseller, so I think you should get the updated version, the little book that still beats the market. The application of buying and selling, though, right, is where we can set ourselves apart. So it's putting the technical analysis on top of the fundamentals. And one thing that I will tell you is that I've really spent most of this year trying to figure out, okay, where are we at with regards to the market, and then trying to be a trader too. And I've always made my money by understanding the big trends and finding the best companies in the big trends, knowing when to go cash and knowing when to get long. And the companies I've picked out, if you take a look objectively, the list of stocks that we have is off the charts good. The ETFs that we picked out were all top 10 performers. So the only mistake we made was not being super fully invested during the Fed driven rally. And now we're stuck here waiting for a pullback and trying to figure out how big that pullback will be so that we know when to get in. And the stock market a year ago was just a shade lower than it is now, right? About 10% lower than it was now. So we don't need a gigantic correction to get back in lower than when we started to get out, because we started to get out in December, January, February. That's when we really got out. So if we can buy back into this market after, say, a 15 to 30% correction, we will have not only gotten in lower than when we got out, we would have lost some opportunity cost, right? We missed a big trade for a large part. We made a lot of money in gold. So, I'm up as much as the market this year. It's just that I'm not as up as much from the bottom. And I think if you compare yourself to people who made a ton of money from the bottom versus what they made, say, over the last 2 years, then you're probably looking at it wrong. You have to take a look at, well, I made the correct trade by getting heavy in cash, and I added gold at the bottom and maybe a couple other schnibbles and things here and there, but I didn't, double my money off the bottom. Well, most people didn't. Even people who got super long at the bottom, unless you bought Tesla and about 20 or 30 other stocks, there weren't a lot of doubles out there. Most folks are up, 10-ish to 20-ish percent year over year, but from the bottom, it seems bigger because from the bottom. This whole V-shaped recovery thing, well, if you fell down the left side of the V, it took you until September just to get back even. So the technical analysis, the understanding of the quantitative data, which again, with them deciding to print so much extra money was easy to miss. I think I missed it, and I look for that stuff. So what we want are good ways to analyze stocks, analyze the sectors, and then be mostly long most of the time, and just be able to sidestep the bigger corrections. I think that we're still going to get that 20 to 30% correction. I think that it could get worse in the short term. There is a lot of risk out there, and that's why we need to analyze some of the things that I'm going to talk about here in the rest of the program. Going back to this acquirers multiple though and the magic formula, I screen for those in StockRover. StockRover is not great for ETFs. For that, I've switched back over to Morningstar. But for stocks, I really haven't found anything better than StockRover, and I look, right? And I look every year because I'm not married to any of these. If somebody comes out with something better, I'll buy it. There is one out there that has an AI attached that I have used, and I just let my subscription run out on that because it was $7,000 a year, and I wasn't living on it. For $7,000 a year, I should live on that service, right? And I wasn't. I have been able to use these screeners. This is the magic formula built in, and then SMID and Marge are the ones that I changed. So I added some screening criteria to these, and then this is for small and mid caps. This is really for large and mega caps, I guess. It shouldn't be really say Marge. Should be more Lega. Should probably be what it should be called. And then I put in acquirers multiple screen in here that mimics the one that he has. And when we take a look at it, you start to see some of the stocks that I talk about. Pulte, enterprise value over operating earnings, right? And that's what he talks about here, enterprise value, operating earnings. So I screen for that. I just want to see where everybody's at. Pulte, you want to buy that one on the pullbacks, right? That's one of the stocks we talk about. Newmont has been one of our biggest holdings. Oh, look at that. AT&T is on the list. AT&T, I think, is dramatically undervalued, and it should even be a holding in growth portfolios because that income that they throw off, you can use that income to buy other small cap stocks if you want to. And probably at some point, like you said, they are going to do a strategic transaction. If you didn't analyze the business from the ground up, you wouldn't know that. But it's something that I've talked about with you over and over and over again. There will be a Warner Media strategic transaction or 2 or 3 or 4. Whether they sell off the whole thing or not, I don't know. But we know that for $1 billion here and $1 billion there, they're selling off little non-focused parts of the business that other companies really do focus on. So they make money, AT&T, by selling it, and then the new company benefits from having the new asset. Other companies on our list, Johnson & Johnson isn't really a big one for me, but, it's Dow Jones, so we keep an eye on it. Lockheed Martin, I've told you, I think is one of the best companies in the world. Just go down the list. Merck, So a lot of the companies that I cover are here. Scott's Miracle-Gro, grow your marijuana. There you go. Northrop is right there. There's quite a few companies, that Apple company is on the list. That Microsoft company is on the list. Yeah, they're all right. So for Stock Rover, they also have a Black Friday sale going on. I'll get you that link. If you are going to screen for your own stocks, this is the screener to have. I say that hands down. It's better than Seeking Alphas. It's better than ValueWalk, or not ValueWalk, Y-Charts. Y-Charts and ValueWalk look the same to me. I don't know that you'll find a better screener. And if you really want to adjust screens to your own criteria, they have base screens. They have a huge library of screeners. It's just tons of them. So you can take these screens and you copy it, and then you go and add different components. So in this magic formula, I take the magic formula, then I add Petrovsky score, because I don't want any companies that have a lot of red flags. And this is really a red flag checklist. So there's 9 criteria. I want to know that at least 5 of them, a majority, are positive. I want a high growth score, and I want a non-negative shareholder yield. Shareholder yield is the combination of buybacks and dividends minus debt. So I want companies that are basically demonstrably throwing off cash, even if they're just reducing debt, which I think is going to be a big deal in the future. I think a lot of companies that are taking on debt right now, 3, 4, 5 years out, are going to have big, big problems. Back to Bloomberg. This is one of the articles that I mentioned a week ago, and a theme that I've been on since June, July, May. During the summer, I told you that we'd get a rebound off the bottom, and then it would slow down again. I could see that the stimulus wasn't going to be enough towards the end of the year, and I was very dubious about whether or not we'd get more stimulus towards the election. And I kept highlighting that Armageddon scenario. The thing that's saving us from Armageddon is clearly the monetary policy from the Fed. If the Fed really tapered, this market would drop through the floor overnight. And you would see limit down in open. You'd see limit down after the circuit breakers expired, and then you'd see limit down the next day. So if the Federal Reserve really is forced to taper because of anything that Mnuchin does, because the Treasury market dries up and they don't have bonds to actually buy, which is actually going on right now. You can find those articles on Bloomberg. We could get that elevator drop. I hope it doesn't happen. It would be good for me because I'm heavy in cash, but I don't think that it's likely. Doesn't mean it can't happen. But you would know these things if you're reading Bloomberg. So I come back to Bloomberg. You should be reading it. What is probably going to happen, and this is from Financial Advisor magazine that I get, and you can just pretend to be a financial advisor if you want to get their stuff. And I think it's worthwhile, actually. I think this is a good read in most cases. And it talks about how America, whether we call it modern monetary theory or not, is we're largely on that road that we're going to have to monetize debts. I still lean towards the idea that they'll be better off doing just a massive helicopter money drop one time, 15-20 trillion dollars all at once, basically print an economy and fix all the problems, and then move towards a balanced budget with interest rates a little bit higher. Will they do it that way? I don't know. I think that they're leaning towards keeping interest rates at absurdly low levels forever, because nobody has the courage to do helicopter money until there's a crisis. So when could there be a crisis? Well, interestingly enough, something on ValueWalk talks about what I've been talking about for how long now. Those of you who have followed me a while know that I've been saying at the end of the decade, end of the 2020s, there'd be a retirement crisis that would cause a massive debt crisis and vice versa. So between the retirement system crisis and the massive overwhelming debt that we're generating late this decade, I've said, we could have major problems. And that's probably when the helicopter money drop comes. And at that point, it's going to need to be 30, 40, 50 trillion dollars. So we could fix all these problems for my estimation is 15 to 20 trillion dollars today, or we can let that double or triple by the end of the decade and really potentially have an inflation mess on our hands. We'll see what they do. But again, ValueWalk Premium covers from some people who are smarter than me this idea that the debt crisis could really smack us towards the end of the decade. And they have some specific reasons why they say 2020, 28. I have said between 2026 and 2031. So, they're just picking a year to see if they're right. It could be anywhere in that range that I gave you. If you want to keep up on global economics, Deloitte has a weekly global economic update. This is just one of the easiest things that you can read. And it's literally a 10-minute read every week. So between Jeff Miller's Watching the Week Ahead, which I usually forward to you, and the Deloitte Weekly Global Economic Update, you put 10 minutes into this every week, you're going to be caught up. And they talk about the same things that I've been talking about. A lot of the industrial and retail sales have gone up, but again, that's off very low levels. So even if everything turns out at the end of the year to be pretty strong, we're still going to be between 3 and 4 percentage points lower than we were in 2019. Well, measure that in dollars. That's over $1 trillion, somewhere between $1 and $2 trillion, smaller economy. That'll leave a mark. So you want to read this, and it gives you good global coverage, which is something I think that we don't always get. Japan, as I've told you, I have had a change in my thought on Japan. While Hong Kong was a big player in finance in the Far East, I wasn't real positive on Japan. And for years, since the early 2000s, I've pointed to their demographic problems and the fact that they were going to have a hard time growing and that they were a resource poor country. All those things have started to change in the last year or two. With the move towards alternative energy, they're not going to be as energy dependent on the rest of the world. They've started to allow some immigration. They're not quite as homogenous. And importantly, and Buffett invested in this in those Japanese brokerages, they're going to get a lot of business that Hong Kong was getting before China cracked down on Hong Kong. Economically speaking, because the Chinese Communist, Xi in particular, wanted to assert their authority, much like Cartman from South Park. You will respect my authority. The Chinese are going to rue the day that they blew up Hong Kong, because Hong Kong's economy is in the shitter right now, and it's going to stay in the shitter a long time. Why? Because they don't have the freedom to interact with the Western world anymore. You're talking trillions and trillions of lost value from Hong Kong because Xi had to assert his authority. You will respect my authority, right? If you're a South Park person, you know that horrible imitation of the voice that I just did. But the reality is that a lot of that business will flow to places like Japan, Singapore, South Korea. I think Japan is far and away the big winner there. And again, that's why Buffett's bought those Japanese brokerages. It's another reason why I've become much more keen on investing in Berkshire Hathaway. They too have made a pivot. towards more technology, towards more growth. They're very strategic. They're holding a lot of cash for the next correction. So I think that Berkshire Hathaway is something that should be on your very short list. Again, ValueWalk here. Some of the things that we picked out that I mentioned earlier were some of the better hedge funds, ETFs. ARK Innovation, right? Top of the list. I've been telling you about this for 2 years. And now all of a sudden it's everybody's darling. And people are throwing me the questions, well, they have that distributor that wants to buy an option to buy the company. It's a negotiating ploy. Kathy Wood's not going to lose control. She'll cut a deal. She'll pay them for their option on the company, and they'll be back to normal. Again, they're very tied to Tesla and some high beta investments. Beta has worked because of the Fed. Beta will work against you if the Fed pulls back. Some of these are pretty good funds. Most of them aren't. ARK is the one that stands out. Okay. And this study here, which you wouldn't get because this is something you'd have to pay for from this firm that did the research, you would never get this, right? So ETFGI is the firm, this is the research. This is something that ValueWalk will give to you as part of their $159 a year subscription or something. So between Bloomberg and these guys, man, you're going to get all the information you need as an investor from the standpoint of the fundamentals and what everybody's doing, and then data at Bloomberg. The other place that I get data, and this is a huge shortcut, is Sentiment Trader. And this is super cheap too, $29 a month or something. They do studies every day that help you determine how risky the market is and what parts of the market are risky. I show the Smart Dumb Money Confidence Index all the time. All the time I show it. And it's weird that a couple of times lately, the smart and dumb money have moved in the same direction. But you see that smart money is still on that downward trend, and they've just been trading. The smart money's been trading. The dumb money just keeps pushing in, and they get shaken out once in a while. They have the nice risk levels here, and this is why I unsubscribed to Hedgeye. These are much more comprehensive studies than what Hedgeye puts out there. Hedgeye has some biases that I have seen blow them up a couple of times. Hedgeye, like me, has been too conservative with our asset allocation since March. Why do I need that, right? So again, I'm pivoting away from the things that were wrong. Why? Because I know that my macro is good. I don't need the guy at Hedgeye telling me what my macro should be. I already know all that stuff. Here, I get data, and that helps me quite a bit. We can see that the short and long-term, longer-term, medium-term for the stock market is high risk right now. Oil investing is high risk right now. Agriculture investing is high risk right now. Bonds are kind of neutral. And then what's low risk right now? Gold. Why would gold be lower risk right now? Because it just had a correction. So the sentiment that you might have, the emotion you might have about gold is, oh my God, it's dropping. I hate that. I might sell it. No, we know that we're in the middle of a long-term secular bull market in gold. So anything cyclical that pulls back prices, you're going to want to buy. And we talked about in the chat room, a couple of us threw up charts and data about where the support was for gold. And there's a pretty strong support level at about $32 a share on the GDX. Gold is a little lower than it is right now. I think 1800-ish, 1766 or something is where gold has pretty big support. I think that's right. But when you come here to Sentiment Trader, it'll help you try to figure out, okay, where should I be allocating new capital right now, or what should I be adjusting my asset allocation to right now? And again, I have a discount code. I'll put that up there for these guys. The active studies right now are overwhelmingly bullish, and they're starting to become more bearish. This is a contrarian indicator, right? Indicators. So here you have your studies showing optimism and those showing pessimism. That's a contrary indicator, because what do we know? Alligator jaws do what? They always snap shut, right? So be very careful about allocating new money to risk assets right now. That was yesterday's. And then each day they have some overlap, but then they have some newer things as well, right? So on that little teeny tiny pullback, just in one day, they move towards neutral in the short term, although the medium term is still pretty risky. There's an article in here that they talk about energy and small cap reversals. If you just want the quick takes, the breakdowns of what's happening and why, these quick articles are just so helpful for you, and they do it mostly in pictures. We all read better with pictures. So sentiment trader, depending again on what level of information you need for your portfolio investing. And again, I'm going to give you a lot of the highlights for everything that I'm going over. But if you want to dig in more, I'm just letting you know. I'd start with Bloomberg, and then ValueWalk, and then Sentiment Trader. Macro Trends is free. This is out there. One of the things I want to point out to you right now about earnings in the S&P 500 is that they're projecting 116 for this year. I think it's going to be just a shade higher, but I don't think there's going to be the growth next year in earnings that people think. I think we get a little tick up in inflation just at the base goods level, the things that don't really get measured all that good. And I think that as companies have to hire people, and they're really past the point of being able to lay anybody new off, although we did see in the last 2 weeks that unemployment numbers were higher than expected, which is what I wrote about, a month ago. I wrote that article that unemployment was going to move into the higher wage sectors, and that would be bad for the stock market at some point. That's happening. Stock market hasn't reflected it yet because money printer goes burr. But at some point, I think we have to recognize that the fundamentals underlying this market are not good. They're probably not going to be good until 2022 or 2023. And we have to discuss amongst ourselves, and we have to think through what are the rates of change in the economy and in earnings that are going to impact share prices. And again, Fed probably trumps all of that. So as bad as things are fundamentally and economically, the Fed just keeps printing money. But again, they may be forced to taper because Mnuchin is pulling money away from them and the treasury market is drying up. It is hard to project what's going to happen politically and what tools will be made available back to the Federal Reserve after the new administration takes office. With the wind down of all of these programs that Mnuchin announced last week happening at the end of the year, we'll see how much money gets given back to the Treasury, how fast it happens. They're supposed to start giving the money back now from the Federal Reserve back to the Treasury, and that was money that was backstopping all the programs that we talked about over the last several months. Probably the last week of the year is not going to be as hot as it usually is. And probably January isn't going to have the typical upsurge that it normally gets. About every fifth or sixth year, January isn't so good. This might be one of those years. And then the question becomes, how quickly can Janet Yellen, who's going to be the new Treasury Secretary, work with the Federal Reserve and maybe with Congress on getting stimulus back into the market to jumpstart this thing, just as the global recovery and the U.S. recovery are all slowing down start right about now. And for sure, the first quarter, which is always a little bit tight, they're going to have to deal with that. So again, risk assets seem very risky to me. I don't think that the next administration will be bad for the stock market. Somebody's asking the question. However, I don't think that they're going to overtly pump it. I'm writing an article right now called The Trump Pump and Dump. And that's really what's going on. People don't want to think, especially people who are supportive of the Republicans and President Trump, people don't want to think about, well, they pumped up the market and now they're going to dump it. Well, President Trump has told you things and then they've happened. Why? Because he had control of the tools. Well, the last thing that he can do on the way out is pull money away from the Federal Reserve, which he's doing, into a first quarter, which we know is going to be bad economically, probably with a split government, We'll see what happens in Georgia. But even if the Democrats win in Georgia, it's still 50-50 in the Senate. And that means that anything that does happen maybe doesn't happen real quick. And as we've discussed over and over again, big things like the CARES Act or TARP back in the financial crisis don't happen without a crisis. Our politicians are cowards. They don't like to explain things to us. Half the time they don't understand it themselves because they have constituencies where their marginal votes are that they don't want to upset the apple cart. So even if they know things, they don't fix them until it's a crisis. And they say, they caused it, I'm fixing it. It happens over and over and over again, the way they play games in politics. And it's both parties. In the last 20 years, it's been more the Republicans, in my opinion. But whatever, I'm not saying they don't both suck. I think they just suck at different levels. So something else that you always want to look at, advisor perspectives, right? Look at the D-short articles. Jill Mislinski is basically taking that over. These charts, I don't even know if they say D-short on them anymore, are just awesome. And she puts them out over and over and over again. You get everything that you need to know about the economy in charts, and this is free. So I'm not even logged in right now. I do have a membership, but I have the free one. And, these charts are very helpful. They help you see the trends. So this is another thing that I bookmarked. And I am updating my financial list to just really focus on the things I kind of live on. And I'm on this one every week. Yardeni, I check this every week for the free stuff, right? Corporate finance briefing, trend lines, and profits and dividends. I want to show you something. This is a trend line from 1920. There's a scenario here that the S&P 500 with 6% growth end up around 5,000 on the S&P 500. However, if you don't use 1920 and you use 1959 instead, you need a higher growth rate, just get to 4,000. Here's my question. What if compound annual growth rate falls? I don't think this is going to happen, but it's not outside the realm of possibility that we get lower outcomes. We're very much priced for perfection right now. You see that? This is basically saying, hey, this is as good as it gets, and we got to stay that good for this market to keep doing what it's doing. Again, adjust for the Fed if you can. Earnings and revenues, right? Trend line going back. And I actually like where they start on this one. I think that the modern economy started in about 1981, came out of stagflation, started the 40-year bull market in bonds. And I want you to think this through. For 40 years, we've been lowering interest rates, and we've had an unprecedented series of bull markets in the stock market. Interest rates are now zero. How do we sustain these bull markets if underlying fundamentals and economics are challenged? I think that's the most diplomatic way to put that. Do we just go to the point of printing money like a third world nation? Or do we fix the problems at some point and take that pain? Nobody wants to take that pain. So nobody solves the problem ahead of time, which is why maybe we don't have another financial crisis till the end of the decade. Someday, pull this webinar out from Thanksgiving 2020 and say, man, Kirk said that they should solve it now and just print 15 or 20 trillion dollars. And then see how much they print at the end of the decade. I bet it's doubled or tripled what I just said. I bet it's 30, 40, 50 trillion dollars through quantitative easing and helicopter money and bazooka money and, red slipper money and whatever the hell else they come up with. So Yardeni is something that you should keep an eye on. He's getting old, but he's got a good team. Let's switch on over to energy, which has had its best month in, I think, ever. Energy is set up to hit the skids, right? Prices already started to come down in the last 24 hours since I wrote my last article that said that really you just got an opportunity to sell energy. I didn't think that rally was going to happen, but again, I'm more of a big picture guy and top down and a bottom up guy when picking out stocks. And I don't trade it always the best in the middle. So one of the things I am doing this year is I'm going to find a trading partner to bring onto the website. And it's going to have to be somebody who is good, and I want them to be able to specifically trade the things that I'm covering because that's where the big money is going to be made. I don't need somebody who's scattershot and just always looking for the new idea. We can trade our universe better on top of the fact that it's a better universe. We'll kick everybody's ass. And in fact, had we just been a little bit more aggressive in March and April, we actually did pick out almost all the best stuff. Apple, ARK, go right down the list. Alternative energy, solar energy, QQQ. In any case, natural gas stocks. You're about to see the price of natural gas flatten. I don't know if it'll come down until, maybe February, March, but they're not going to get the bump they usually get at the end of the year and into winter. It already happened. And now I'm sitting here in Wisconsin, and I don't like the 40 degrees and rainy that we had last week, but all of a sudden it's 55, 60 degrees again. It's Thanksgiving. That's not normal weather in Wisconsin, in case you're not aware. It should be 35 right now, or 30 with some snow for the deer hunters. And in the northern part of Wisconsin, they are actually getting that. But you got to be pretty far north. OPEC, over here at Hard Energy. If you're into energy, Hard Energy is one of the top 4 or 5, maybe 3 or 2 energy sites out there. And their blog is free. Their other information is not. So OPEC already sees oil demand recovery not as good. I've told you that. And now the big guys are coming out and saying the same thing. You do have an edge as a small investor. Your edge is being able to see things and react a little bit faster than the big guys. Now, on the trading, it's different. You're up against supercomputers. But our ability to have a thesis and monitor that information and think it through properly is available. So my oil short was early, but now that the price has rebounded in oil, if you wanted to short oil right now, I think that you'd be doing yourself a favor. Again, ValueWalk, you just do a search for oil, which I did here, and you get a whole bunch of articles. And I think that one of the articles I think should jump out at you is this one, the Rockefellers, right? That's the family. That's the oil family. The Rockefellers are telling you to sell oil, and a lot of them are selling theirs. Not all of them, but a lot of them. I think this is an interesting article. Talks about Occidental, right? And this one from May is pretty good, which really affirms the secular trend that I've been trying to tell people. So oil is dying. It's not going to die as fast as coal did. It's dying. Take 20, 30 years, but how hard is it going to be to invest in oil if the frackers just keep running into problems? And given that their balance sheets are as bad as they are, with the exception of Pioneer, really, among the bigger ones, if they can't produce more oil at higher prices, which is what their balance sheets say they need to be able to do, how do they survive long term? Most of the oil companies are just zombies. You can trade them, but an awful lot of them are going to go to zero. And if you just Google oil bankruptcy, there's a law firm out there. Haynes and Boone, there you go, comes up first. Go and take a look at that. They cover the bankruptcies for you. It's insane. Look at that. How many bankruptcies? So the idea that we're in any type of oil bull market is kind of silly. Now, at some point, oil prices will go up because enough of these companies will have gone out of business and merged, and they will control, and they'll wipe out a lot of shareholders along the way. And bondholders who aren't secured are going to get very little. And it's only the secured shareholders, bondholders, who will become new shareholders as these companies merge, and two merger equal companies, to say $5 billion companies merge, and they become an $8 billion company, and they wipe out a whole bunch of employees, and they're very cautious about what they're going to do for production. And in those mergers, right, they change their share structure, and they wipe out dividends, and they dilute. I agree with Sheffield over at Pioneer Energy. I think there's only going to be a handful of viable shale plays in the next year or two. I think Pioneer will be one of them. I actually think they're the best situated. Their merger with Parsley, I think, is awesome. It's the one that I talked about over a year ago that I thought should happen. Pioneer and Parsley are ideally situated to be part of the swing oil producer solution. They're low debt, so they're not forced to produce, and they have some of the best shale in the world. So Pioneer is going to do all right if anybody does all right. I'm not sure anybody will do all right in oil, but if somebody's going to, it'll be Pioneer. Over on Barron's, I made a comment, so I'll share it with you. My strategy for oil investing is to just buy the indexes in the Middle East. So I'm looking at how to invest in the Middle East because they are going to be the big winners when oil gets back up to $60 a barrel in a year or two. It's not going to be the American frackers who are debt heavy, possible exception of Pioneer. EOGs are kind of okay, right? Hess might be kind of okay because I've gone from sour to kind of neutral on the South America projects. And then Conoco, which I've written articles about a few years ago, being the smartest ones out there. I think Sheffield actually has turned out to be pretty smart over at Pioneer. But the Conoco team was selling assets 3, 4, 5, 6 years ago, and everybody else is trying to buy assets. Who looks smart now? So if you take a look at XOP, which is the one I told everybody to sell on this rally, this bar right here, that move was entirely based on the leverage that I've talked to you about. People on margin buying calls, leverage on leverage. 2008 called and said, hey, what could go wrong with leverage on leverage? And now it's starting to drift. Why? No buyers. Leverage costs money. Even though it doesn't cost much money, it costs money. And if nobody's going to buy it to pump it up, and the market makers eventually get a little smarter and, challenge some of these guys, and maybe they hedge their books a little slower to cause some jitterbugging, this is going to close back up. XOP will come down to 50-ish pretty quick. And ultimately, I think it still comes all the way back down here to 35-ish, and probably down here. And as it has fewer and fewer companies, I think the spider will just add a few companies to the XLE index, and I think they'll probably get rid of this one altogether. All right. Any macro type questions or ETF type questions that we can cover today? No? Okay. Denise says that Bloomberg says $1.99 a month is the first month. Your first month of Bloomberg, the deal used to be $1.99 your first month, but then it bumped you back up. I would just buy Bloomberg for $199 for a year. It's not something that you're going to decide in a month you don't want. I'm telling you, if you get Bloomberg, you're going to go here every single day, probably a couple times at least. Because the one thing you'll get addicted to is you'll start looking at the futures before you go to bed. Now, I don't recommend doing this if you stay awake at night thinking about things, right? I can't talk to my girlfriend about anything serious after dinner time because she thinks about it. Me, when I go to bed, she teases me and then she gets angry. And I think it's more anger now that I could fall asleep in 5 or 10 minutes almost any night. Last night I had a hard time because I ate too damn much. But in general, certain things you don't want to look at right before bed. I look at this right before bed because I've trained myself to sleep well. And I usually wake up because I think about these things in my sleep. I'm not really sure. But I seem to have better thoughts when I wake up after I look at stuff. Somebody asks, is there anything to buy other than gold stocks right now? Individually, there's always stocks, right? So if we go to Stock Rover and we take a look at watch lists, go to plug and play growth stocks. Oh, actually, let me show you something. Here, this is the one. Stocks with RSI over 70. Look at this. That's insanity. You see this chart? That's insane. Look at how many stocks have an RSI over 70. They're all overbought. So we come here, pull up our chart, and a whole bunch of stocks over 70. There's a bunch that are right on top of it. Okay, so we go down here and take a look at NVIDIA. I don't think it's come down enough. Well, here, look at it over here. These guys, TradingView is running a special too, so I'll put that up for you. If you don't have TradingView and you have any intention of swing trading, you need to have it. Your brokerage probably has some decent charting, but it won't be this. So if you're swing trading, you need this. If you're just position trading, you're fine with what your brokerage offers. All right, there you go. I'll get rid of the asset lines. We don't need that. So you take a look at NVIDIA. Get rid of that. There you go. That makes it easier to read. And we want to go back to 2018 is how far back we want to look. And what you see is you have people who were the buyers, and now as NVIDIA gets weak, they want to lock in their profits, so they sell. Then you have this area in here where there's not a lot of buyers. So you probably can raise this a little bit. I think NVIDIA probably makes a run at $400 a share. I'm not so sure it bounces and holds this 475 line. So even though NVIDIA's almost oversold, I don't think it's as far down as it can go. And this is a daily chart. We take a look at the RSI. I'm just using NVIDIA as an example. But now if you flip it to the weekly chart at the speed of the internet, there we go. Still has a long way to go on the way down. So the nicest thing about TradingView is I can switch back and forth between the different time frames. So I can see what the short-term trend is. I can go to, for a position trader, the more important one is the weekly. So we want prices that are either oversold or very close to oversold. If we had bought at the bottom here when it was oversold in 2018, sold it up here, bought it in April, sold it up here, right? We had done all the right things. Look how far apart those trades are. 14 months, coronavirus crash, right? That's not something people expected, but it was overbought on the weekly chart. So regardless of coronavirus, you should have been selling it up here no matter what. At least trimming it, right? Scaling out. You buy it back down here. So for position traders, your Fidelity, your Schwab account, or Interactive Brokers will have this basic stuff. It won't be as easy to navigate. It won't have all these tools. If you're a swing trader, or you at least want to have that in your toolbox, you should have TradingView because it'll allow you to do your own studies. But again, if you're a position trader, meaning longer term trades, holding stuff for 6 months or longer, you don't need TradingView. You can just look at mine. But if you're going to try to trade week to week, you need a Ninja Trader or a TradingView or whatever else is out there. You need one of the ones that are more comprehensive. TC2000. There's a bunch of them. I like TradingView because it's easy to look at and it's cheap. It's way cheaper than just about everything else. So, all right. Oh, going back. The answer is there's not a lot to buy. Even the dividend stocks have gotten pumped up. You know, go down here, Newmont and Barrick. Look at that at the bottom. So you want to take a look at Newmont. This probably has a little lower to go because it's in the S&P 500. It's a weekly chart. When it gets down here, though, you should be buying it. Daily is going to be way down there, right? So you get a little bit of bounce, but ultimately you want to see that weekly a little bit lower, a little closer to this zone. I mean, this is a no-brainer. But right in here, you have to have some judgment. And, you know, sometimes you just got to hold your breath and buy. Barrick Gold. Make sure we check to get the right symbol. All right, this is your weekly chart. It's in that area. Could it go lower? Yeah, but you should be scaling in the Barrick Gold right now. It's not an S&P 500 stock. It's Canadian, so we're not sure how low it'll go. Nibble, nibble, nibble. So you should have a position in Barrick Gold at this point, right? It's in our buy zone. In a margin-driven sell-off, I don't really put that on the charts, but in a margin-driven sell-off, it can go lower. Margin calls. I'm going to leave it here. I mean, if it got down to 12, I think this is, again, one of those stocks where I might just wipe out my portfolio and put, you know, quarter of my money in one stock here. It's unfortunate the market's so overvalued, right? Everybody feels like they should be buying. But again, look at how much is overbought. Something bad has to happen. Question is how bad? I don't know how bad. Depends on what government and the Fed do to prevent it from getting worse, right? There's a wide range of outcomes that could occur. Armageddon scenario is not out of play yet, which is unfortunate. Unlikely, but not out of play. Just above 300 on SPY is probably where you need to start scaling in unless things look horrible, right? And everything's headed straight down and there's no reprieve in sight. At 270s area and then 240s. Could we set a new low? We could. Again, I think that would depend on government, a central bank. I don't know what to think about Powell under Biden. Not really sure. I don't think he's a Trump loyalist. I think he's going to try to do what he needs to do. And he's asking for more treasuries in the market, which means the reason that the Fed asks for fiscal policy from the government, right? The reason they want to see more deficit spending from the government is because that's debt that they can soak up and reflow through the banking system and prop up stocks and bonds. The problem with that, and why there's probably a debt crisis coming at some point, is eventually there's too much debt. You would think that we'd be there already, but we're not. GDP compared to debt is still not all that egregious. We've done it before in history, but we're kind of at the limits. All right, we're at World War II levels of debt right now. And when you factor in the Fed balance sheet, a little higher. So all these zombie companies that just got propped up by the Fed and the corporate bond buying program, you have to ask yourself the question in 5-ish years, when all those bonds start coming due, what are their options? They're going to need to be bailed out, or they're going to have to dilute, or there could be a big wave of take unders or take privates. In either case, they're going to have to wipe out shareholders. Whether it's a total wipeout or just a big wipeout, hard to know. But companies with really bad balance sheets, you need to run from them. And companies that say they have a good balance sheet, but you can see the big debt number and they're projecting out growth that'll support the debt, you better make sure that growth is real, because a lot of them don't have it. Philip Morris comes to mind. Altria comes to mind. Those companies, I don't want anything to do with. Somebody asks if I'm building a gold stock portfolio that's going to be roughly 20% of my holdings, which is, I think, the high end. How do I build it? And my answer would be 2 or 3% in Newmont, 2 or 3% in Barrick Gold, and then buy the basket, GDX, for the rest. So you go 14, 3 and 3, give or take. Maybe go to 4% on the individual stocks. I think Barrick and Newmont are that good. Go 12, 4 and 4. Could do that. Depends on your risk tolerance. At some point, we'll want to buy gold proper again. And I'm not really interested in the junior miner ETF, but I am interested in some of the companies in there. So as you add a handful of juniors, you just reduce your GDX holding a little bit to keep your asset allocation in line. All right. A few more stock questions. You can ask those on Monday in the stock call. All right. So Monday, we have the stocks of the week call. Tuesday morning, we have the covered call, which is option selling for retirees and near retirees. And this afternoon, I will have a list of Good Friday subscriptions that you might want. It's only like 4 or 5 of them out there. Covered them today, basically. And I think I actually have a deal on Barron's. I got to see if it's out there. But Barron's is running a special, and it's super cheap. I think it's $52 a year, and I think the one I have is $39. So, Barron's, I will say this about Barron's. If you want the super condensed version of the Wall Street Journal with more company coverage and investment coverage and stripping out a lot of the other economics and business, if you want the investment version of the Wall Street Journal, I think that's what Barron's really would be. It's the stripped down version of the Wall Street Journal. I think Barron's is a pretty good complement to Bloomberg. So I read Barron's every week. And I actually get that one, the paper copy, because then if I need it to like paint or something, I have that. So I painted last week, and I opened up the Barron's and I put it on the paper on the ground and put the paint can on top. All right. I hope everybody had a pretty good Turkey Day. Hope everybody has a good weekend. And I will see you on Monday. And there's quite a bit of content coming out. I have like 11 articles started that I think I can knock out 2 a day for the next week. And I think you're going to like that. But, going into the next correction, which I think is closer than people want to think that it is, we need to be ready for that. Because whether we buy here or here or here and here or here and here, we're going to have to scale in at least twice, I would be my guess. Unless we get one of those weeks like we had in March. But when you take a look at the waviness of the market, and you don't need Elliott waves to recognize the waviness of the market, right? Because there's always an alternate count on Elliott waves. This here, I can show you, if I go to Forex Analytics or the other Elliott Wave site that I use, I can show you, I think, 3 counts here. And then you have the longer term count with little counts inside. Just know that things ebb and flow between Fibonacci levels and where there's heavy support for buying. So this structure, I should have had this up for a whole year, actually forever. I always look at this stuff and I see it here, but I think it's easier for you to see here where the buying and selling pressure is, right? Huge buyers came in when this came down to here. And this might even been super secret plunge protection team. In any case, the Fed pumped all kinds of money into the market right here. People used it to buy stocks. Could have been the banks, could have been the hedge funds, could have been a little bit of all of the above. The millennials who got their $1,200 checks started buying, and they're all becoming good traders. And the one thing, and I have sent this letter both to Bloomberg and the Matt Taibbi over at Rolling Stone. If you go on Discord and Reddit and you pay attention, you will soon figure out that there are hedge fund proxies directing millennials on what to buy and sell. Why would they be doing that? Why would the hedge funds be providing, with a degree of separation, trading advice to the millennials who are now the marginal player in the stock market because they all think of themselves as great traders? Questions I see are insanely stupid from a lot of them. They're just followers. There are some good ones, and I think they're better than the boomers when it comes to trading, but they're being directed by the hedge funds the same way the investment banks directed the hedge funds before the financial crisis. So before the financial crisis, the hedge funds were getting their cues from Goldman Sachs, Morgan Stanley, Nomura, etc. The ones that had hedge fund platforms. Now you can open a hedge fund right over at Interactive Brokers. Why would the hedge funds be giving the millennials trading advice on a day-to-day basis? Nobody wants to answer it? Well, then I'll leave you to think about it. All right. Have a great weekend.